The S&P 500 has plunged 10% in just 2 days, only the fourth time since 1952 and the fastest drop since the COVID crash. Meanwhile, Bitcoin is up 3% over the same period. This might be one of Bitcoin's strongest performances relative to the S&P 500. It looks like Bitcoin has found a bottom, but the tariff war isn't slowing down. Will relentless tariffs derail the bull run, or has Bitcoin locked into a lengthening cycle that could stretch into Q4 2025 and beyond? In this video, we'll break it all down, exploring possible scenarios with a level-headed approach so you can build your own thesis. I'll also share my thoughts on why the traditional 4-year cycle might be a thing of the past. If that sounds good to you, hit that like button to support the channel, and don't forget to subscribe for more content like this. Alright, let's get straight to the million-dollar question. Is the 4-year cycle finally coming to an end? I believe we're in a lengthening cycle, breaking away from the usual pattern. Crypto is evolving, and if you're still playing by the old rules, you'll get left behind. Since this channel started, I've stuck to one key point. The days of quick, easy gains are fading as the industry matures. You can't rely on the old playbook anymore. You have to anticipate what's coming next. The 4-year cycle has always revolved around Bitcoin halvings, events that slash miner rewards and tighten new supply. In the early years, these moments had a massive impact. But with the 2024 halving, the reward dropped from 6.25 to 3.125 BTC per block, reducing daily issuance by approximately 0.0023% relative to the 19.7 million coins already in circulation. The impact keeps shrinking as Bitcoin scales. Each halving cuts a smaller portion of the total supply, weakening its influence over time. What was once a major scarcity driver no longer dictates the market rhythm like it used to. For context, MicroStrategy bought 28,959 BTC in March 2025 alone. That's equivalent to 64 days worth of supply at the current mining rate of 450 BTC per day. At this point, new supply emissions barely move the needle. Another major factor is macroeconomic influence. Bitcoin is now more affected by interest rates, central bank policies, and global liquidity than just having cycles. When liquidity is high, Bitcoin thrives. When it's tight, it struggles. With institutional investors entering through ETFs, Bitcoin is increasingly behaving like a traditional asset, reacting to macro conditions rather than a predictable 4-year cycle. This shift is making halvings less of a driving force in the market. Increasing institutional adoption has reduced retail-driven volatility and cycle patterns. Bitcoin ETFs have stepped up as a big deal, chipping away at the old cycle even more. US spot ETFs have scooped up over 530,000 Bitcoin, around 2.5% of the total supply. MicroStrategy holds 528,185 Bitcoin as well. That's another 2.5%. That's a ton of cash from big institutions and everyday investors, flowing in without touching the usual crypto routes. Two things pop out from this. First, the Bitcoin wealth effect is pretty much gone. Back in the day, Bitcoin profits would spill over into altcoins, pumping their market cap to $1.8 trillion in 2021. Now, ETF holders are just sitting tight with their Bitcoin, leaving altcoins high and dry. Second, retail's playing a different game. Newbies aren't bothering with stepping stones like Ethereum, they're diving straight into riskier stuff like meme coins. That skips the old build-up they used to lift altcoins. ETFs have rewired how the market works, tearing down the 4-year setup. Altcoins are feeling the squeeze from this shift. ETF money keeps flooding into Bitcoin, while retail investors chase fast-moving on-chain trends instead of stacking altcoins the old way. Simply holding alts doesn't carry the same weight anymore. At the same time, the entire crypto market is expanding. With the total market cap approaching $3 trillion, diminishing returns are starting to take hold. That sharp 4-year boom and bust cycle is flattening, smoothing out the extreme peaks. For Bitcoin, this could mean a steady grind upward rather than wild volatility. Altcoins, however, face a tougher road ahead. This shift smooths out the rough patches too. The long, brutal bear markets of the old cycle, like 2018's 18-month grind, are less likely now. In 2024, the market stayed dynamic. November saw meme coins like Dogecoin double in days. December pushed AI tokens into the spotlight. January shifted focus to agent-based projects. The cycle is stretching but breaking into shorter, sharper trends. Money is constantly moving, creating frequent profit opportunities. The key is spotting these waves instead of waiting for one big, obvious surge. Alright, now let's examine the possibilities for this cycle. If you still believe in the 4-year Bitcoin cycle, this chart serves as a key reference. It tracks Bitcoin's historical price movements, mapping out market phases and the timing of peaks and corrections. Historically, bull markets have lasted around 17 months after a halving, followed by an 11-month decline. This pattern held in 2017 and 2021, but the 2013 cycle played out differently, with both the bull and bear phases lasting 13 months. Returns in 2013 were also far higher since Bitcoin was still in its early growth phase. While this historical pattern offers useful insights, it doesn't factor in external macroeconomic forces, which now play a much larger role in shaping Bitcoin's price action. I've previously outlined 3 possible scenarios. Given how Trump's tariffs have reshaped the landscape, let's take another look at them with fresh perspective. Starting with the left-translated scenario, I don't expect this to play out, and if it does, I'm in trouble. This would mean Bitcoin topped at $109,000, marking an early cycle peak. Fortunately, I've positioned myself better this time with most of my holdings in Bitcoin and top altcoins. As I mentioned in my recent portfolio update, 27% is in Bitcoin and 12% in stablecoins, making up 39% in safer assets. My insurance in case this worst-case scenario unfolds. That said, I have strong reasons to believe the top isn't in yet. None of the key indicators I track are even close to flashing warning signs. But more importantly, this isn't just about indicators, it's about monetary policy. I can't imagine a world where we see quantitative easing and Bitcoin doesn't rally. So, what's the playbook scenario? In this case, macro believers will be left coping while 4-year cycle fans celebrate. Bitcoin would continue its run, mirroring past cycles and peaking around September 2025. But there's a catch. This cycle is already underperforming compared to previous ones. Look at the bull market comparison chart. If Bitcoin had followed the same post-halving trajectory as 2021, it would already be above $200,000. This is a clear sign of diminishing returns. 2021 underperformed 2017, and 2017 underperformed 2013. The pattern continues. Here's something interesting. The average time to an all-time high is 508 days. If Bitcoin aligns with the 2021 cycle's timing, the peak would land at a modest $147,000, a realistic target and the minimum level many expect Bitcoin to breach this cycle. Alright, let's talk about the right-translated scenario. This is the most likely outcome, shaped by macroeconomic forces and global liquidity shifts. Imagine a scenario where tariffs crush global markets, dragging stocks and Bitcoin down in the initial panic. The 10-year Treasury yield, already trending below 4%, plunges further as uncertainty grows. By late 2025, it dips below 3.5%, flashing recession warnings. With yields collapsing, the US seizes the moment to refinance its massive debt, reducing fiscal strain. By Q4 2025, the Federal Reserve, facing a slowing economy, cuts interest rates and restarts quantitative easing, a play straight out of late 2018's handbook. Tech stocks, battered by the trade war, surge back as cheap money floods the system. Bitcoin, initially sidelined, explodes as it solidifies its role as both a portfolio hedge and a growth asset. Institutional FOMO kicks in, retail follows, and with QE pumping liquidity, Bitcoin rockets to $180,000 by early 2026, riding the wave of a macroeconomic reversal. Even though I'm bullish and see this as the most likely scenario, I'm also well positioned for the worst-case outcome. I won't blindly cling to a single thesis. I'll stay adaptable and have my exit plans ready to avoid getting stuck holding bags. I'll be posting a dedicated video on my exit strategy soon, so make sure you're subscribed. Which scenario do you think is more likely to play out? Drop your thoughts in the comments and I'll see you in the next one.